Welcome to the deep dive. For quite a few quarters now, Vonovia, Germany's real estate giant, has been navigating some pretty choppy waters. Investors have been watching closely.
Very closely.
But these H1 2025 results, they feel like more than just numbers. They seem to paint a picture of maybe a strategic shift, signals that things might actually be turning around. So today we're going to cut through the noise from the earnings call, dig into those critical insights, and help you figure out if Vonovia really is setting a more confident course.
Let's do it.
Okay, so let's kick things off with the headline numbers. Vonovia delivered a remarkably strong first half for 2025. Management even called it very successful.
They did.
And the market seemed to agree, right? The shares got a nice little bump after the announcement. What were the standout figures that grabbed everyone's attention?
Yeah, you're right. The numbers really do jump out. Adjusted EBT for H1, it surged almost 11%, 10.9% year over year, hit nearly 985 million euros.
Yeah.
And that wasn't just, meeting expectations. It beat the consensus by about 4%, which suggests maybe the market has been underestimating their resilience a bit.
Interesting point. And EBITDA.
Adjusted EBITDA also looked good, climbed 12% to over 1.4 billion euros. That was about 2% above what analysts were expecting. So solid beats there.
And if we look past just the earnings, the cash flow often tells a deeper story, right, about operational strength. How did that look?
Absolutely. And it looked, really strong. Operating free cash flow showed some serious power. It was up, get this, 53.4%.
Wow, 53%.
Yeah, reached over 1.17 billion euros. That shows they're really generating significant cash, which is obviously crucial for paying down debt later.
Crucial.
And rental revenue was up too, a healthy 2.6%. So you take these strong operational numbers and then management raises the full year guidance. It definitely set a positive tone for the call, a confident one.
Okay, so headline numbers, undeniably strong. But, for experienced investors, it's always about what's under the surface. What are the key strategic shifts, the management insights that are really driving this renewed confidence, not just, short-term market reaction?
Right. Well, this H1 performance, it really signals a clear pivot. They seem to be moving quite distinctly from stabilization, maybe even retrenchment, towards managed growth.
Managed growth, okay.
And a key highlight here, maybe the biggest statement, is the turnaround in asset values. We actually saw like-for-like portfolio value growth, only 1.3% in H1, but growth nonetheless.
After declines, that's significant.
It is.
Yeah.
And management was very explicit. They stated their conviction that market yields will no longer expand. And crucially, that the turnaround in asset values has been completed.
That's a bold statement.
It's a very powerful assertion. It provides, strong support for their balance sheet, their overall valuation story.
Management sounding convinced about that asset value turnaround is certainly, welcome news for many. But given the volatility we've seen, how much weight can we really put on that statement? And maybe more importantly, how did this newfound confidence translate into their actual revised financial outlook for 2025?
That's fair. Is it just hot? Well, they backed it up by raising their 2025 guidance pretty much across the board.
Oh, really? How so?
Organic rent growth, they now expect it to be greater than 4%. That's up from around 4% before. Adjusted EBITDA, now guided towards the upper end of the 2.7 to 2.8 billion euro range.
Okay, pushing the top end.
Exactly. And Adjusted EBT got a substantial bump raised by 100 million euros, now projected between 1.85 and 1.95 billion. And the CEO really hammered this home, emphasizing their market environment and operating fundamentals remain always rock solid. It just reinforces that positive outlook, suggests they really feel they have clear visibility now.
That sustained confidence, it really comes through.
Yep.
Okay, let's dig into the operational segments then. How's the core rental business doing? The bread and butter. And what about those non-rental segments they're pushing, as part of their Strategy 28? Are they really starting to move the needle?
Yeah, the rental segment seems definitely fully on track. They reported robust organic rent growth, 4.4% overall. About 2.9% of that came from just market rent growth, and another 1.5% from investment-driven growth, like modernizations.
Okay.
Occupancy rates, collection rates, still exceptionally high. And tenant turnover, the fluctuation rate, actually dropped slightly below 8%.
Which means people are staying put.
Exactly. It reflects just how tight the market conditions are, especially in German cities. Management highlighted this, saying it gives them, and I quote, Very, very good visibility on strong rental growth for effectively the next 10 years plus.
10 years plus visibility. That's quite something.
That's basically a landlord's dream scenario, right?
Yeah.
Almost a captive market, giving them huge pricing power.
So that structural supply-demand issue in German cities, it's still a major tailwind, a solid foundation. But like you said, management's really pushing these non-rental areas for diversification. Are these genuinely accelerating, as they claim? Or are there still big hurdles to making them, really meaningful contributors?
That's the key question, isn't it? Sustainability and scale. Management's message is definitely that these segments are accelerating profitability. It lines up with their Strategy 28 plan, diversify beyond just collecting rent.
And the evidence.
Well, the value-add segment's contribution surged, up 77% year over year, mostly driven by more modernization work, portfolio investments, recurring sales volumes, also up almost 25% year over year, and margins are improving, getting closer to that 30-35% target they have.
Okay, so the trajectory looks good, even if the base is smaller.
Exactly. The growth trajectory is undeniable. Seems to be gaining real momentum.
And what about development? I know that's been a tough area, and they've been focused hard on cutting costs. What's the latest there, and what's the strategy, given the history?
Yeah, that's been a critical focus. They're intensely focused on getting construction costs down to around 3,500 euros per square meter for new builds.
Ambitious target.
It is, but they say they've already started projects, one in Berlin, one in Dresden, that are actually hitting this target. So it proves it can be done, building profitably again. What's interesting, though, is that a lot of the H1 development profit actually came from selling land plots. Management basically said their land bank is too big, partly from acquiring Deutsche Wohnen.
Right, legacy stuff.
Exactly. So now they're actively refilling the construction pipeline, about 3,000 starts planned for this year. It's kind of a dual strategy. Yep. Free up capital, selling off old land, bridge the profit gap, while starting new cost-efficient projects. They're aiming for 20% gross margins on about €1 billion of investment per year.
Sounds pragmatic, trying to optimize a segment that's been, frankly, a drag.
Pretty much.
They also mentioned managed to green initiatives. Now, for our listeners, this isn't just, environmental PR. It seems like a clever strategic lever they're pulling to unlock value. What's the idea here? How does it sit in?
Yeah, this is actually quite innovative strategically. They gave an example. A pilot project in Cologne, 134 units. They bought them at 21 times rent multiple.
Okay.
The plan is to modernize these older, less energy efficient places, improve sustainability, insulation, heating, and then resell them at a substantially higher value and also higher rent after the renovation.
So upgrading existing stock to capture value?
Exactly. It's another way to enhance asset value, diversify earnings, and capture value from that whole ESG transition trend. It's creating value by improving what they already own, not just building new stuff.
Right. But arguably the biggest strategic move this half, the real chess piece, was finally getting the full integration of Deutsche Wohnen done. That's been hanging out there for a while.
Got one time coming.
So from your analysis, what are the real game-changing implications now that this complex integration is finally complete?
Yeah, this is where the long-term strategy really starts to crystallize, I think. The domination and profit and loss transfer agreement, the DPLTA, it's done, complete,
Really?
Which means full integration, allowing Vonovia to, as they put it, leverage the full potential on the larger scale. Key benefits are both operational and financial.
Okay, break that down.
Operationally, they're streamlining things, fully integrating Deutsche Wohnen's craftsman organization into Vonovia's existing setup. That should generate more profit through synergies, efficiencies.
Makes sense.
Financially, it allows for much more efficient cash pooling. Basically removes barriers, makes it easier to move cash around the combined company. Now there is the Apollo stake to consider.
Right. Apollo has about 10% economic stake in DW. How does that play out?
It means a modest dilution, about 3% to adjusted EBT per share after accounting for minorities. But, and this is key, that's more than offset by the €1 billion in cash they got from Apollo.
Ah, so the cash inflow outweighs the dilution.
Significantly.
Right.
It provides extra financial flexibility, helps with deleveraging, and they estimate it saves about €40 million a year in interest costs too. So yeah, it's a really smart way to simplify the structure and unlock value that was kind of trapped before.
Speaking of deleveraging and financing, after all these moves, the cash inflows, how are the debt KPIs looking? Are they really on that sustainable path to lower leverage?
Management was pretty emphatic on this. They said leverage is well under control and aligned with their BBB plus Bay1 rating criteria.
Okay, numbers.
The loan-to-value LTV ratio stood at 45.9% on a pro forma basis. And they anticipate a clear downward trend for that number.
Okay.
Net debt to EBITDA was 13.7 times, also described as moving in the right direction. And their interest coverage ratio, ICR, is currently 3.5 times, which hits their internal target. So the path seems clear. The deleverage via EBITDA growth and more selective asset sales.
Okay, so the headline ratios are moving correctly. Beyond those, did they make any specific financing moves to actively, manage their debt profile or boost liquidity?
Yeah, they were quite active. A couple of savvy moves worth noting. They issued 1.3 billion euros in convertible bonds. The cash coupon on those is super attractive, less than 50 basis points.
Wow, very low.
Right. They figure that'll save them about 45 million euros a year in interest compared to issuing straight bonds. That's a big win in this rate environment.
Definitely. Anything else?
Yes. They also bought back 800 million euros worth of two existing bonds, maturing in 2027 and 2030. So, further optimizing their liabilities, cutting future interest costs. These actions, plus that billion euros cash from Apollo, boosted their pro forma cash position to a very comfortable 3.7 billion euros.
So strong liquidity actively managing the debt stack.
Exactly. They've actively reduced the future interest burden.
Okay, so after digesting all of that, what does this deep dive really mean for you, the investor? Thinking about the broader market context, Vonovia's future, what's the core narrative here?
Well, the positive market reaction, that share price bump, it does suggest that Vonovia's strategic recalibration is hitting the right notes with investors.
Seems so.
The confirmed turnaround in asset values, combined with those solid rental fundamentals and the non-rental bits accelerating. It offers a pretty compelling story for sustained earnings, maybe valuation growth down the line.
So it's not just defense anymore.
I think that's the key insight. It's not just the numbers themselves, but the strategic flexibility they seem to have bought. With this cash flow, the deleveraging path, Vonovia isn't just playing defense. They look like they're setting the stage for, well, opportunistic growth in what looks like a rebalancing market.
And it feels like getting that Deutsche Wohnen integration finally done is a major catalyst. Streamlining operations, unlocking scale, that's got to help over time.
Precisely. Integrating the craftsman teams, better cash pooling, those are practical, real benefits that will directly help them hit their 2028 targets. And that Apollo deal, it's clever. It brings in cash, de-risks the balance sheet a bit while managing those minority interests.
Right.
And for investors, management made a point of distinguishing between accounting minorities and cash minorities. They're prioritizing the cash impact, which you see in the operating free cash flow.
Yeah.
It gives a perhaps more accurate economic picture.
Makes sense. Okay, looking ahead then, what should we be watching for in the near term? Any specific upcoming events or catalysts you should have on your radar, things that could move the needle further?
Yeah, there are definitely a few key things coming up. The Q3 2025 results, they're due November 5th. Those are expected to show the positive impact from Germany's new Investitionsbooster law.
Ah, the investment booster law. What's the impact there?
Critically, this law is expected to cut Vonovia's deferred tax liabilities by, well, a huge amount, somewhere between 2.2 and 2.3 billion euros.
Billion with a B.
Billion with a B. It's basically an accounting boost that will significantly lift their IFRS equity without any cash actually leaving the company. So watch for that in Q3.
Big balance sheet impact. Okay, what else?
Beyond that, just continued execution, right? Hitting their raised 2025 guidance. Making progress on selling those non-core assets. They want half gone by year end, the rest by end of 2026, assuming they get the right price, and seeing results from those managed to green monetizations.
Right, seeing if that strategy pays off.
Exactly. And, while the stock has lagged the DAX index over the last, say, 3 to 12 months, this current path suggests there's potential for a re-rating. As deleveraging happens, earnings grow organically, all backed by that structural housing shortage in Germany, maybe some helpful policy tailwinds.
All right, well, that brings us to our this is not financial advice segment. Time to pitch an outrageous but plausible trade idea for your consideration. Take it away.
Okay, so given Vonovia's clear pivot to manage growth, those rock-solid rental fundamentals we talked about, and especially that big quantifiable deferred tax liability reduction coming in Q3, here's my proposal for the Hypothetical Investment Committee.
Lay it on us.
A long position in Vonovia, hedged judiciously, with a short position in a broad German equity index ETF, something like the iShares Core DAX UCITES ETF.
Long Vonovia, short the DAX. Intriguing. Unpack the thesis for us. Why this particular play for an experienced investor?
Okay, the core idea is this. Vonovia's very defensive rental income, that deep-rooted base, combined with these proactive moves like Manage to Green and the cost-cutting in development,
Yeah.
it gives them an organic growth profile that feels increasingly decoupled from the wider market swings.
Okay, less correlated maybe.
Right, and that upcoming 2.2 to 2.3 billion euro equity boost from the tax law in Q3, that's a known, quantifiable catalyst, and I think it's still underappreciated by standard valuation models.
A hidden kicker.
Potentially. So you get this organic equity injection plus their commitment to deleveraging through actual EBITDA growth and selling assets.
Yeah.
It puts them in a favorable spot. The short DAX leg is simply the macro hedge. It captures, any systemic risks, a broader economic slowdown that might hit everything, including Vonovia to some extent.
So isolating the Vonovia specific story.
Exactly. It lets us benefit from Vonovia's specific value creation story, their operational execution, that regulatory tailwind, while hedging out some of the general market noise. We're essentially betting that Vonovia's specific strengths will let it significantly outperform its home market. It feels like a compelling risk-adjusted setup right now.
Okay, quite the compelling pitch. So to recap this deep dive for everyone listening, Vonovia's H1 2025 results. Strong financials, a confirmed turnaround, or at least management believes so in asset values, and pretty clear strategic execution, both in the core rental business and those accelerating non-rental segments.
Yep, and the full Deutsche Wohnen integration, plus those smart financing moves, they really strengthen the overall position. And it's all happening against that backdrop of, very favorable German housing market dynamics and some helpful policy.
The long-term outlook seems underpinned by that structural housing shortage, ongoing efficiencies, and definitely an improving balance sheet picture. Suggests a company that's maybe poised to capitalize, right?
On its core strengths, yes, and also these new strategic levers they're pulling. Seems that way.
Okay. Now, as always, remember, this discussion is purely for informational purposes. It is absolutely not financial advice. We strongly, strongly encourage all of you listening to do your own thorough due diligence, consider multiple angles. What's one final thought you'd leave our listeners with today? Something building on this discussion.
Final thought. I'd say keep a really close eye on two things going forward. First, the actual synergy realization from the Deutsche Wohnen integration. Are the savings coming through as planned? And second, the pace and profitability of those Manage to Green monetizations.
Why those two specifically?
Because those are the newer, more dynamic parts of the story. They'll really show Vonovia's ability to create value beyond just the steady rental income. They could be key indicators of whether this whole pivot to managed growth truly delivers on its full potential.
Great point. Watching the execution on the newer initiatives. Fantastic insight. Thank you for tuning in to the deep dive. Stay informed and always remember to look beneath the surface.